Hello everyone. Under this problem, you're going to see how to treat a house which is partly self-occupied and partly let out. So if you go back to the previous video which we have seen, if any house is being partly self-occupied and partly let out during a financial year or during a previous year, it will be taken as being let out throughout the year. So let us look at the problem here. We have two houses, house 1 and house 2. The information has been given: the municipal valuation, the fair rent, the standard rent, then the actual rent received, then the period in which the house is being self-occupied and the period in which the house is being let out, then the municipal tax which is due and paid, then the interest on borrowed money. Then you have to see that the loan taken to construct house 2 is still outstanding. It means that it's yet to be fully paid. Then the loan was taken in 1998. You have to compute the income from house property for Mr. Let us look at the solution. Now if you look at the solution, we have house 1 and house 2. So the first step is to find out the reasonable expected rent. For the reasonable expected rent, we have to see, or we have to compare between the municipal value of fair rent, whichever is higher, but subject to the maximum of SR. Now let us look at the problem. So the municipal valuation for house 1 is 96,000. The fair rent is 88,000. So the municipal valuation is higher, that is 96,000, but the standard rent is 90,000. So it has to be subject to the standard rent. So the expected reasonable rent for house 1 will be 90,000. Then for house 2, the municipal valuation is 90,000, the fair rent is 96,000. So the fair rent is higher, that is 96,000, but the standard rent is 1,08,000. So since the fair rent is within a standard rent, the reasonable expected rent will be 96,000 for house 2. So the reasonable expected rent for house 1 is 90,000, for house 2 is 96,000. Then step 2, you have to find out the rent received / receivable after deducting unrealized rent, but before adjusting loss due to vacancy. In this problem, we don't have any unrealized rent nor there's any loss due to vacancy. But now we have to see the rent received during the period of let out of these two houses. So for house 1, the house has been let out from 1/12/2019 to 31st 3 2020. So it means that for house 1, the house was being let out for 4 months. So the rent per month is 9,000. So 9,000 into 4 will get 36,000. And for house 2, the house was being let out from 1/4/2019 to 30th/11/2019. So it will be 8 months, and the rent per month is 10,000. So 10,000 to 8 will be 80,000. So the rent received for house 1 is 36,000 and the rent received for house 2 is 80,000. Since there's no loss due to vacancy, then to get the gross annual value, it will be simply step 1 or step 2, whichever is higher. So in the case of house 1, step 1 is higher, that is 90,000, and in the case of step 2 also, step 1 is higher, that is 96,000. Then from the gross annual value, you have to less the municipal tax. So in case of municipal tax, it will be allowed to be minus from the gross annual value only the tax paid. Any tax due will not be taken into consideration. So for house 1, the tax paid is 3,000, but for house 2, there's no amount for tax paid. So after deducting the municipal tax, we'll get a net annual value. So for house 1, it is 87,000, and for house 2, it is 96,000. Then from the net annual value, we have to minus the deduction under section 24. So first of all, we have the standard deduction under section 24A, which is 30% of the net annual value. For house 1 will be 26,100, for house 2 will be 28,800. Then we have the interest on loan under section 24B. So for house 1, it's been given the problem itself. For house 1, it's 10,000, and for house 2, it's 42,000. Then from here, we'll get the, after deducting from the net annual value, the deduction under section 24, we'll have the income from house property. For house 1 will be 50,900, and for house 2 will be 76,100. So the income from house property in total will be 1,27,000.